This video is educational. It is not financial, tax, or legal advice. Citizens Life Group is a senior consumer advocacy firm and educational resource for seniors and their families. Reviewed by Jeffrey Hallman Sr., Florida License 0266. Universal life premiums rise because the cost of insurance charge increases with age, and earlier illustrations projected stronger interest crediting than the policy actually delivered. Universal life premiums rise when the cost of insurance charge inside the policy increases. A universal life policy is structured around three moving parts: the premium the owner pays in, the cash value account that builds inside the policy, and the cost of insurance charge the insurer deducts each month to keep the death benefit in force. The cost of insurance charge is not the same as the premium. The premium funds the cash value. The cash value funds the cost of insurance charge. When the cash value cannot fund the cost of insurance charge in a given year, the insurer raises the required premium or the policy lapses. This structure is defined in the NAIC Universal Life Insurance Model regulation. As the insured ages, the cost of insurance charge climbs, and the net amount at risk, the difference between the death benefit and the cash value, climbs with it. A policy that looks sustainable at age 60 may demand a substantially higher premium at age 78, even when the policy is doing exactly what its contract specifies. Universal life premiums rise from two forces: increasing cost of insurance charges and underperforming interest crediting rates. The first force is mortality cost. Cost of insurance charges are calibrated to the insurer's mortality table, typically the 2017 Commissioner's Standard Ordinary Table or the 2015 Valuation Basic Table, depending on policy vintage. Mortality charges scale upward with attained age and accelerate materially after age 75 and again after age 80. The second force is the interest credited to the policy's cash value. Universal life policies sold during the 1990s and 2000s were typically illustrated assuming a 5 to 7% crediting rate. Actual crediting rates since the 2008 financial crisis have averaged 2 to 4% across the industry, according to insurer annual disclosures. The two forces compound. Weak crediting depletes the cash value. As the cash value falls, the net amount at risk rises. As the net amount at risk rises, the cost of insurance charge rises with it, and the higher charge depletes the cash value faster. The policy was not mispriced. It was illustrated under crediting assumptions that did not hold across 2 decades of low rates. Actuarial Guideline. 49 reset how insurers illustrate universal life policies. Earlier illustrations regularly overpromise crediting performance. The National Association of Insurance Commissioners adopted Actuarial Guideline 49 in 2015 to cap how aggressively insurers could illustrate indexed universal life crediting rates at the point of sale. The NAIC followed with Actuarial Guideline 49A in 2020, which further restricted illustrated rates and addressed bonus crediting structures, and Actuarial Guideline 49B in 2023, which extended the framework to additional product designs. Policies issued before 2015 were illustrated under pre-AG 49 assumptions, often projecting crediting performance the rate environment after 2008 has not delivered. When a senior receives an in-force illustration in 2026, that document reflects current crediting assumptions under the AG 49 series. For a policy issued in 1998 or 2003, the 2026 in-force illustration commonly shows the policy lapsing 5 to 15 years earlier than the original sales illustration projected. The current illustration is not pessimistic. It is calibrated to current conditions. The gap between the original document and the 2026 document accounts for a substantial portion of what policyholders experience as premium shock. Universal life owners facing premium increases have 4 options: pay more, reduce face, surrender, or sell. Option 1, pay the higher premium and keep the policy at its original death benefit. This is the right answer when the death benefit is still needed and the higher premium is affordable. Option 2, reduce the face value. The insurer recalculates the policy at a smaller death benefit with a correspondingly lower required premium. Option 3, surrender the policy to the insurer for the cash surrender value, ending the contract. Option 4, sell the policy on the regulated secondary market through a licensed life settlement broker. The broker represents the seller and owes a fiduciary duty under Florida Statute Section 626.9911, subsection 4, and parallel statutes in 43 other states. The National Council of Insurance Legislators Life Settlement Model Act, last amended in November 2024, requires brokers to disclose all available alternatives, including accelerated death benefits, policy loans, and reduced paid-up insurance before any settlement contract. Florida statute. Section 626.9923 lists the required pre-contract disclosures to viators. Listing all 4 options with equal weight is not a marketing choice. It is the statutory standard. A life settlement beats surrender when the secondary market offers more than the cash surrender value, which is most qualifying cases. Institutional buyers price a universal life policy on the present value of the expected death benefit less the expected future premiums, discounted at the buyer's required rate of return. The largest variable in that calculation is life expectancy. The 3 primary life expectancy underwriters in the United States market are 21st, Fasano, and Polaris. Their reports use the 2015 Valuation Basic Table, or proprietary mortality tables, and assign actual to expected mortality ratios that published audits report at 98 to 103% for the major providers. When the insured's health profile produces a life expectancy materially shorter than the carrier's original mortality assumption, the secondary market value can substantially exceed the cash surrender value. Qualification floors are generally an insured age of 65 or older, a face value of at least $100,000, and a policy more than 2 years past issuance. The United States Supreme Court decision in Grigsby v. Russell, decided in 1911, established that a life insurance policy is transferable personal property. Justice Oliver Wendell Holmes, Jr. wrote the unanimous opinion. The legal foundation for the secondary market is 115 years old. Lisa's 2024 annual market survey reported a 6.5 times average multiple over cash surrender value industry-wide. The Life Insurance Settlement Association reported 2,699 closed settlement transactions in 2024, totaling $3.4 billion in face value purchased by buyers and $601 million paid to consumers. Of that $601 million, $511 million was paid above what those same consumers would have received by surrendering their policies. The 6.5 times multiple is a record high in the survey, up from 6.2 times in 2023. The Conning, 2025. Life Settlement Strategic Study estimated the average annual gross market potential at $224 billion, rising to approximately $230 billion by 2031. The Insurance Studies Institute reported in 2010 that 90% of seniors who let a policy lapse said they would have considered selling it had they known the option existed. The Life Insurance Settlement Association also reports that 11 million policies worth $754 billion are surrendered or lapsed each year, and that 55% of seniors aged 65 and over are unaware life settlements exist. The penetration gap between the $224 billion potential market and the $3.4 billion actually settled in 2024 is a function of awareness, not regulation. Every state with a life settlement statute permits these transactions. The right option depends on age, health, coverage need, and tax treatment of each pathway. 4 questions structure the decision. First, do surviving beneficiaries still need the death benefit? If yes, paying the higher premium or reducing the face value protects coverage. Second, what is the insured's current age and health status? Settlements generally require age 65 or older and a life expectancy under 15 years. Third, what are the tax consequences? Surrender gain above basis is taxed entirely as ordinary income under Internal Revenue Code Section 72. E-settlement proceeds follow the 3-tier framework established by Internal Revenue Service, Revenue Ruling 2009-13, and modified by the Tax Cuts and Jobs Act of 2017. Tax-free up to basis, ordinary income from basis to cash surrender value, capital gains above cash surrender value. Sellers receive Form 1099 LS reporting gross proceeds and Form 1099 SB reporting basis. Fourth, What does the policyholder want the decision to accomplish? Florida Statute Section 6, 26.9924 provides a 15-day unconditional rescission right after the viator receives proceeds. Some states extend that window to 60 days under the NAIC Viatical Settlements Model, Act 697. The 2024 industry data shows the decision rarely turns on the mechanics of the policy. It turns on the alternative that fits the household's actual situation. Consult a tax advisor before any policy decision. This video was reviewed by Jeffrey Hallman Sr., Florida License 0266, Viatical Settlement Broker. Citizens Life Group is a senior consumer advocacy firm. It is not a licensed broker or provider. Educational only. Not financial, tax, or legal advice.